Good morning, everyone, and happy summer. Thanks so much for being with us today for our GASB update for hospitals and healthcare systems. We're happy to be here. If you are a returning guest, you know that Forvis Mazar prides itself on helping organizations throughout the country with accounting, financial reporting, and operational matters. Today, we're going to be focused on the accounting and auditing areas for GASB hospitals, which makes up a significant portion of the healthcare environment. I'm excited to introduce our panel for today, but first, as your moderator, my name is Brian Pavona. I'm a partner with Forvis Mazar in Chicago. I am a member of the AICPA Healthcare Expert Panel. And as I look to moderate today, I'm employing one of my golden rules, which is to surround myself by folks who are brighter and smarter than me. And so I'm excited for our panel. We have Darren Taltrin here today. Darren is a fellow partner of mine. He sits in the Florida market as our healthcare leader there. In addition to over 15 years of experience in accounting and auditing in the healthcare industry, he is a member of the Government Accounting Standards Advisory Council and is the AICPA Healthcare Expert Panel's GASB subgroup member. Darren, thanks for being here. We have another leader from Forvis Mazar. Danielle Zimmerman is a partner in our Texas market. Again, with over 15 years of experience, and in addition to being an excellent teammate and subject matter expert in the area of accounting and financial reporting, she is a certified healthcare financial professional and a fellow of the HFMA. And a special warm welcome to Austin Jones as one of our panelist members. We hear a lot that the audience for these types of webinars really appreciates not only the auditor's perspective, but also the auditee or the organization, the healthcare provider's perspective. And so Austin is joining us from a healthcare system. He is the Chief Financial Officer of North Kansas City Hospital. And it is a 451 licensed bed as part of the Meritus Health System there in Kansas City. With over 14 years of experience in both public accounting and then also financial reporting for healthcare systems. So thanks for being here, panel. Real quickly, we're going to go through our learning objectives for today. Our learning objectives include that we are going to talk through the lessons learned from GASB statements 87 and 96. We promise we'll do a little recap on that too. Understanding new and pending GASB pronouncements, and my final one, have fun. So with that, we will take questions throughout. If you want to type them, we'll try to get to them. So go ahead and use that chat feature to send questions, and Darren has promised me I can ask all the hard ones to him. With that, let's though first start off with a polling question. And let's just get a flavor for who's joining us today. So what is your organization's fiscal year end, please? Is it June? Is it September? Is it December? Is it something else? And if you are from the community but not a provider, you can check other as well.
I know here in Texas, we're very September year-end heavy. So we have a lot of September 30th, and then we have a handful of December year ends, but we certainly have a plethora of September year ends. So I'll be excited to see how many of our Texas clients are joining us today.
Wonderful. And Austin, what is your fiscal year end?
We're on a June fiscal year end, but I do remember those September Texas year ends. Is that the state fiscal year?
No, our state fiscal year is actually 8/31. So we like to keep it extra complicated by having a state fiscal year of 8/31 and a federal fiscal year of 9/30. So it makes certain payment program funding mechanisms and measurements very interesting.
Wonderful, wonderful. All right, so look at this. We got a lot of folks with December and a good mix of folks from June and September as well. All right, so we've got that first polling question behind us. And before we jump into sort of lessons learned and what to think about going forward for GASB Statement 87 and 96, Darren, can you help us with a recap of those two standards, please?
Yeah, absolutely. And I see that other bucket on the fiscal year ends. And I'm looking for that February year end. I haven't seen one yet, but I want to find the one that, every few years, you don't know which day it's going to fall on. But if you have a February year end, give me a call. I'd love to talk about it. But yes, we're going to spend just the first few minutes this morning doing a quick refresh on what we're talking about today, GASB Statement 87 and 96. So if you've been under a rock the last few years, maybe this is your first day dealing, you've just joined an organization that follows governmental accounting, GASB, but most of you lucky ones out there, you probably, like me, attended, I don't know, something like 1 billion different webinars covering GASB Statement 87 and 96. But we're going to do just a real quick few-minute refresh from a 100,000-foot view to level set about what we're talking about here. So, of course, GASB 87, that's pretty well in the rearview mirror at this point from an implementation perspective. It was effective for years beginning after June 15th of 21. So for most organizations, we're probably, into our second year post-implementation, looking down at the third year post-implementation. 96 obviously is more recent. It was just effective for June year ends in 23 and thereafter. So everyone just had the joy of completing that implementation and are probably coming up on the end of or midstream of their first year post-implementation. So we're not going to go through, obviously, the details of the standards, but 87 and 96 are very similar. We're putting items on the balance sheet that historically may not have been there, particularly for 96. We know for 87 that leases, we're now putting the right to use asset on the books and a corresponding liability for those non-financial assets over which an organization has the right to control the use of for a period of time in an exchange or exchange-like transaction. These are effectively, the GASB looks at a lease arrangement and a SPEED, a subscription-based IT arrangement, as a financing event. So, of course, we got rid of the pre-GASB 87 capital versus operating distinction. The FASB did maintain those two different classifications, but GASB said if you've got a lease and it's more than 12 months, or for 96, if you've got a SPEDA and it's more than 12 months, then you've just got a lease or SPEDA. There is no distinction between capital and operating. And of course, again, the accounting, we're familiar with it. We're going to look at that future payment stream for these contracts, look at the fixed or in substance fixed payments, any residual guarantees at the end of them. We're going to discount that cash flow stream back and put a liability on the books. And then we're going to put a right to use asset on the books related to that liability, adjusted for any incremental direct costs or prepayments. Now, that's from the lessee side. If you're a lessor, and so healthcare systems, often we have medical office buildings or other leasing operations from a lessor perspective. You're really mirroring the liability side by putting a receivable on the books for your lease receivable. And then you're going to not de-recognize the asset that's being leased. You keep that on the books. And then you offset your lease receivable with a deferred inflow of resources. And over the periods of the contract, on the lessee side, you amortize the right to use asset over the shorter of the useful life for the lease contract. The liability side, you're going to amortize that and have interest expense and a reduction of liability based on the payment stream. Lessor side, you do the same thing for the receivable. You just continue to depreciate your asset over its useful life, and then you recognize income from the leasing arrangement in a systematic and rational manner over the term of the lease. So that's probably the shortest GASB 87 refresher ever. So looking at 96 now, 96 is almost identical to 87 in terms of the mechanics of how you account for it, but there are some nuances and things that made 96 unique relative to 87, some of which we're going to go into more detail with Danielle and Austin in a dialogue following this refresh. But a subscription-based IT arrangement, the definition is similar to lease. It's a contract that conveys control of a right to use an asset. But in this case, we're talking about IT software, alone or in combination with some underlying tangible IT assets over a period of time in an exchange or exchange-like transaction. So the definition's effectively identical. We're just replacing the nature of the asset or assets that we are obtaining a right to use and financing for, from non-financial tangible assets to software and potentially with a tangible underlying asset. Now, looking at whether really whether you're in scope and whether you're looking at the underlying IT asset, you need to figure out, are you getting access to underlying IT assets where you get basically the control and the economics? So separate from the software, are you getting hardware, underlying IT assets where you get to obtain the service capacity from that asset and to determine the nature and manner of the use of that asset? And if so, and if the software component is insignificant, the software component of this contract is insignificant relative to that underlying IT asset, then you're really scoped out of 96 and you should be looking back to 87, the lease guidance. So you do need to think about and evaluate whether and the extent to which you're obtaining a right to use software versus the underlying IT assets following that guidance. Other items that are scoped out of 96, when you're the vendor, when you're the entity that is, let's say, leasing or providing software to others, then you don't follow 96. If you have a P3, a public-private partnership under Statement 94, those arrangements are also scoped out. And then if you are entering into a perpetual license, then you're going to follow Statement 51. So perpetual license, now that doesn't mean a license or an arrangement where you have auto renewals for a perpetual term or where you have termination rights. Those you do have to evaluate whether we have a term there. But a truly perpetual license, you are scoped out of Statement 96. Recognition and measurement, again, we're looking at the lease guidance. Look at your fixed payment stream. You discount it back and put a liability on the books. You offset that with a right to use subscription asset, adjusted for any prepayments or initial direct costs. You can also add to that asset cost any implementation costs that you incur, as long as they're within this initial implementation stage, as part of getting the assets ready for use. So there's guidance in 96 that gives you indications of preliminary project stage, initial implementation stage, operational additional implementation stage. You're looking for that middle section in order to capitalize costs related to implementation. And then we're going to amortize the asset and amortize and reduce the liability in a manner substantially identical to the lease standard. Now, once we've done the heavy lift of the implementation itself, well, now we have to deal with a number of factors, including, the processes, the systems, the controls to maintain the standard, identify and evaluate and make the judgments we need to around new contracts that are coming on board. You also have to have ways to identify and account for contract modifications. If you amend a contract, if you terminate a contract, if you make changes. And from an accounting perspective, under 96, there's basically three ways to account for modification. In some instances, you may actually account for a modification incrementally as a separate contract. So if you meet the two criteria listed here, where you're getting access to underlying tangible IT assets that were not originally included in the SPEDA contract, and the incremental payment from the modification is associated with those underlying IT assets, is not unreasonable. Then you're going to keep the existing accounting in place for the original contract and set effectively a new contract for the modifications and account for that separately. Otherwise, a modification is going to result in a remeasurement of your liability. So if you extend the term, if you modify the contract to extend the term, to increase the payments, presumably you're going to be getting additional functionality or additional rights under the contract. Then you're just going to remeasure the liability associated with the changes in the payment stream and offset that against your right to use asset. Now, one thing to think about there, though, is you do need to make sure you're getting additional functionality or a component that is related to the software and your right to use the software. So if you're getting additional rights in the way of additional services that are being provided, additional support or maintenance, those would not be considered a modification and get accounted for as a remeasurement. So you do need to think about that nuance. Then, of course, if you're terminating or reducing the payment stream, the term, otherwise you may have a full or partial termination, in which case you're going to remeasure the liability, reduce the asset, If you completely terminate, you take the asset to zero and you end up with a gain or loss. So that's the quick refresh on 87 and 96. But, again, that's all in your rearview mirror. We've done the implementation. Now it's a question of how do you maintain these standards? It would be great if that lift was all just set it and forget it, but that's not really the case. There's some things obviously that are in place that how do you maintain and how do you continue to comply with the standards on a go-forward basis? So Danielle and Austin walk us through that conversation. But I think first, Brian, we have another polling question.
Yeah, let's do that first. So let's take our second polling question. We've got over 430 people joining us. Many of them need CPE. What method did you use to calculate GASB 87 and 96 liabilities? Did you use an Excel spreadsheet, a third-party software, both, or did you have an outside party assist with that? And as we're looking at that, Darren and team, I see there's a great diversity of types of organizations joining in that 430. Many GASB hospital entities, as you would expect, but I see some GASB organizations that are outside of healthcare, and that's okay. When you think about what we're covering today, is certainly applicable. What's interesting is there's also a lot of FASB folks, and maybe that's where some of those 1231 year ends were coming, and I bet they need some GASB Yellow Book CPE credit. So with that, it looks like the majority is using Excel spreadsheet for this. So with that, thank you, Darren, for that excellent recap. And Danielle and Austin, let's go on to the impacts of this.
Awesome. Thank you so much. So Austin, kind of think back. I know GASB 87 was about 2 years ago now for you, so you're coming up on year 3, but just big picture, if you had to put yourself back in your shoes from when you had to adopt GASB 87, now that hindsight is always 2020, how would you describe your implementation process, or what went well, or what could you have improved on during that GASB 87 implementation cycle?
Yeah, well, first I think I have to say, the timing was perfect because I had just left an organization that was under FASB. We had just implemented, what was it, ASC 842. And so I was in the weeds on that, trying to figure out the imputed interest and net present value and all these things. And then I came here to a governmental hospital and we started all over. So yeah, when I look back, there were some lessons learned on the ASC 842 side of things. I think one of the things that we did well was quickly engage an advisor, and we reached out to our auditors and said, do you know who we can help with, get to help with this? And Fortis did a good job of setting us up with that lease vision tool. So we kind of had that hybrid in terms of getting started off onto the right foot. But yeah, I think overall, when I look back, some of the things we learned from it were just how many contracts we really have out there. So one of the starting points, the foundations of implementing this and maintaining it is a good contract management software. Because within health systems, you just don't realize how many you have on the supply side that are feeding into GASB 87, and then on the software side that are feeding into GASB 96. And so that was important. And then just changing up the workflows and the routing so that we had the right people involved at the right times. Because before it just wasn't as necessary, and we had to kind of insert ourselves in different parts of the process.
Yeah, I definitely think that was one of the hardest bits as somebody on the outside that was just looking in to help audit it or to go through the audit process. It certainly was getting their arms wrapped around what is our complete population of leases. A lot of times we knew where the material leases were, but that was easy on the GASB 87 side. But then on the 96 side, it was very hard to come up with a complete set or a complete population, I think, because on the lease side, generally, if you had material lease activity, there was some sort of footnote disclosure in your audit report, generally about future minimum lease payments. But maybe you can compare and contrast that to GASB 96 and what went well or what didn't go so well with GASB 96, because it seems like from the auditor's perspective, a lot of our clients didn't have as good of a grasp on the complete population of those SPIDA arrangements, those GASB 96 arrangements. And I think that was a heavier lift perhaps than the GASB 87 lease arrangement. So can you maybe talk us through your GASB 96 implementation and what went well or what didn't go so hot during that process?
Yeah, no, that's a great question, Danielle. Number one for us, we had much less of an impact from 87 simply because we had fewer right of use assets, fewer leases with disposable type agreements built into them. On the 96 side, it was pretty massive in terms of the number of contracts out there that we had to address. And then another piece of it that I didn't anticipate was just the challenge that it presented with kind of hindsight review. So budgeting for it was challenging just based on the timing of it. So getting it into the budget and saying, okay, how's this going to impact us? But then also in the monthly reviews to say, where are we at with purchase services? Because at a high level, I couldn't really tell. I could see that purchase services were down, which would be great in theory, but it was all moving down into the depreciation amortization line item. And so talking my board of trustees through that and the finance committee was challenging, and then getting the right processes set up. But I think overall, I have a really great team here at the hospital that created a master spreadsheet, and they managed it very well. Just getting that spreadsheet with all the critical components of the contracts built into it. So I think, just being very organized, having that kind of methodical approach to the cadence of when you're touching it and how you're breaking it out, especially for reporting purposes to help decision makers.
Yeah, absolutely. On the screen here, we have some of the most common implementation impacts that we've typically seen with our client base. One of the things that you touched on is the debt covenants. And here in Texas, a lot of our governmental hospitals, while they have bonds or debt, they don't necessarily have debt covenants because a lot of the debt is guaranteed by property taxes. Talk with us a little bit about if your facility has debt and if you do have debt covenants, what impact did GASB 87 and GASB 96 have on your covenants, and what sort of ripple effect did implementing these standards have on your debt covenants or your financial statement ratios?
Yeah, that's a good question. We do have debt. Our lenders are private banks, so we just have a couple lenders, a couple notes outstanding. We don't have any public debt. So we do have covenants that were affected by it, but affected to kind of a small extent in terms of the debt service coverage ratio. It did have a slight impact on that. And in our case, it had a slight favorable impact. And on the debt to cap ratio, we did have a slight unfavorable. But because it was so small in general, it didn't cause any concern. It was just more of an explanatory item for, of course, the board of trustees as we report out. And then, of course, doing more of a hindsight review to see, how we can update in a hindsight perspective as we look at the trending to see how we're doing on liquidity ratios. But overall, it really didn't cause any issues or any concerns. The amount of debt we have is so small that it just kind of tweaked them a little bit more than usual. In terms of engaging the banks, we didn't really have to do much on that front because it didn't change much, but we did have to kind of look into the bond covenants and understand how those might be impacted.
Yeah, I could see how maybe some banks would say this isn't debt, we're not going to include it in your ratios, or this is debt, we're going to include it in your ratios, because these agreements have existed all along. Now the accounting treatment is just changing for how to account for those types of arrangements. And so in a lot of instances, our clients have reached out to us asking, how should we compute our covenants? And we just encourage them to get back with bond counsel to say, do you want this included or excluded? Or perhaps to issue some sort of addendum to then explicitly say, we're only looking at long-term debt. We're not including these lease or SPIDA arrangements. So that just kind of helps us get all on the same page, because those debt arrangements were entered into prior to this guidance being authoritative or issued. And so we as auditors don't know if the banks want that included or excluded. And so we've really encouraged our clients that do have the debt covenants, get with your bond counsel or get some sort of clarification in writing from your bank or whoever it is that's looking at those types of covenants. But I want to kind of move forward a little bit. I want you to kind of talk with us a little bit about talking with your board and getting your board comfortable with these accounting standards. A lot of times we were going back and restating prior year financial statements to put the asset and the lease obligation on the books for GASB 87. The following year, we then came along and adopted GASB 96, which then required going backwards and restating for 96 as well. Talk with us about what sort of education process you used with your board and your stakeholders to understand these impacts from adopting these accounting standards.
Yeah, that's a great question. This is one of those topics that come up at the board level that my board of trustees classify as wonky, is their term. And they say, oh, he's got another wonky topic to discuss with us. So this definitely falls into that category. It was one of those topics where I thought, okay, this could lead us down a rabbit trail that maybe I don't want to go down, where it just gets more and more complicated, or we can hit it at the high level. And so I did actually work with our auditors to kind of create somewhat of a script, so to speak. And they also did a great job when they came in to present to really pare it down into something that was manageable and understandable in more layman's terms. Being a public hospital, you have a different makeup of board of trustees. Sometimes in private hospitals, for-profit or not-for-profit, you have a lot of bankers and lawyers and accountants. And with ours, the majority is community members, and a lot of them have not been exposed to much more than a P&L. So it was a little bit more than they're used to. But I think what we did was we tried to just explain it in layman's terms and piece it out and say, this is what an asset is. An asset has value. This is why the new accounting standards call it something with value. We didn't get into the kind of sub-level of things. We just said it's going to be moving around on the balance sheet, the P&L, and this is kind of how it's going to flow going forward. So it went well. Didn't have a lot of tough questions.
Yeah. What process do you guys use for contract retention or catching that complete population of your GASB 96 and your GASB 87 arrangements? Like, did you have to implement additional internal controls so now those arrangements are passing through accounting before they're entered into? Or is there some sort of checklist to make sure that it passes by the accounting office? Or just talk with us a little bit about how that has now changed after the adoption of these standards, since there is, an asset and a corresponding liability that goes along with it.
Yeah, that's a really good question. We did change some processes. We have what many health systems have in terms of a kind of a capital review process with a capital expenditure request, and it's got the form, and it's got all the typical data that you would request. We've got a capital review committee. But what we have found is that these keep coming up, right? So we may have new contracts that are coming in all the time, and our leadership think, this is just a simple contract. I'm going to sign it and move it forward. And then it comes up kind of at the last minute. We have to tuck it in with these. So we are, I will say, we have done a great job of implementing internal controls kind of in that checklist format when people put contracts through. We've got a good process of reviewing the contracts within my procurement team as well as the accounting team. They work really closely and especially closely now with the IT side. But then, we're still changing processes to better capture, because it's a complex process in terms of getting any contract through. You've got your IT, your legal, your accounting, all the reviews that have to take place, and now we're adding one thing. So it's one of those where we're constantly evolving.
That makes my little auditor heart happy to hear you say that you've implemented some good internal controls. So I want to touch on that and make sure everybody hears that, because this standard is not a one and done. It does have ongoing implementation impacts as far as it's essentially just like fixed assets, right? We have to keep maintaining that fixed asset ledger. We have to do the same thing for 96 and 87. Talk with us a little bit about how you and your accounting team are going to identify if there are modifications made or terminations to any existing contracts, so that you can get so that accounting is aware of those types of issues and can account for those correctly.
Yeah, no, that's a good question. I think, part of it is systematic, where you set up your checklist, your forms that have to be checked off and signed off by certain departments before it moves forward to execution for renewal or otherwise. Now, on the renewal side, there is always kind of that exposure to the evergreens. So really just a thorough contract review process taking place internally. But then second to that is just the increased level of communication between supply chain IT and operations as well, and accounting. So making sure that those channels of communication are in place, and that, you know, a lot of times in my role, I'm not involved in that day-to-day work, but what I have to do a good job of is connecting and making sure that those relationships are there and those barriers are not in place to prevent that communication. So, yeah.
One time I had a client tell me that I, as the auditor, I report the news and he makes the news. And so I want to use that to dovetail into talking about your budget. Have these standards had an impact on your budget process with, I hear a lot of clients talk about they have an operating budget and they now have a capital budget. So is GASB 87 and GASB 96 causing an impact to your budget? And as a public hospital, you know, with your budget going forward, I would assume it's approved by some sort of commissioner's court, or maybe there's a higher level of authority that has to approve it. Talk with us a little bit about any implications it's having on your budget now that you're about 1 or 2 years in on the adoption of both of these standards.
Yeah, it definitely has had an impact, and it's impacted both the operating and the capital budget. Part of the operating piece is, like many health systems, and by the way, we do have a board of trustees that are appointed by the mayor of the city. So we're governmental in that form, but managed by an independent board. And so in fact, the timing is good. We're June 30, and our budget goes to the board of trustees on Monday. But it will have kind of trending data, and that goes back to what I mentioned earlier, where it's important for the board to see consistent trending that helps them understand really what's going on and tells the story as true as possible. And so creating normalized schedules so that they can see, okay, this is purchase services over the years, this is depreciation amortization, and then helping them understand, okay, how does that operational budget feed the capital budget? Where are we going to come up with this money for capital? We've got cash flow from operations, we've got debt service, we've got philanthropic funding, other non-operating with interest, dividends, joint ventures that we have. And so we did have to tweak some things this year to say, okay, what is true cash flow from operations? Because in the past it was, well, you've got EBITDA, right? And now we've got, you know, maybe 15 million worth of contracts, purchase services that are feeding into that depreciation amortization line item. So we did have to make some adjustments. And it brought up a good discussion this year in the finance committee, which approves before the board. But yeah, that was the main thing. It was just helping them understand how EBITDA doesn't exactly measure up for cash flow from operations like it did before.
Yeah, that's a great point. Just to kind of wrap up here were some of the unique items that we would catch or we would find while we were auditing both of these standards. One of them, I would say the two most common items that we would find, or perhaps that were typically immaterial, but maybe now are growing to be more material, would be the free equipment in connection with purchase agreement. So I think a lot of times there'll be a certain piece of equipment that's perhaps baked in with, oh, hit this purchase quantity. So those types of items now have to be considered under GASB 87. The other one is the usage-based agreements that we oftentimes see with the copy machines. So any of these items stick out, or any commentary on these types of unique items? Or did you suddenly find out, oh my goodness, there's some leases in here, or there's some something that needs to be recorded that we didn't previously catch under the old standard?
We did, and I think we're probably not alone in our health system in that every piece of equipment in our hospital seems to be free, but somehow it's very expensive. There's no such thing as free lunch, right? So we have a lot of right of use assets, especially in the surgical operating procedural space, and most of those we were aware of. And again, I think we had enough for a while that it wasn't a huge impact. But yeah, that's very common, usage-based, and then the free equipment with a purchase agreement or a minimum kind of commitment. Those are very common.
Yeah, very, very common. And I think in the past they might have gotten looked over or not considered. But I think with, hopefully your new and improved internal controls, you're now keeping an eye out for these types of arrangements, right?
Yeah, and
So
it's kind of funny. There's always this game within health systems, and I came from a much larger health system where the game had much higher stakes, I would say. You have to try to get capital, right? And you need what you need to get your job done. And it was funny. We were very involved in trying to figure out, okay, how can we get this piece of equipment we really need, but not take away from that little bit of that sliver of capital we got from the national office. And when I came here, I thought, okay, well, we're an independent hospital. We can just allocate capital as needed. But of course, there's always constraints. And, it wasn't too long before my own team here, the operations team, is going, okay, I got denied on that. But if I go at this angle and I keep it under this threshold. So it's funny how our operations team, they become like forensic accountants when they need to get capital and they can't get it initially. So that's been kind of a little bit entertaining and also just brought our attention to, okay, we got to set the internal controls in a way that'll keep everyone honest.
Yeah, that's so true. I had some clients sending me, here's what our contract looks like. How can we maybe get this modified so that we can scope it out of 87 or 96? And how can we craft this to get this certain accounting so that I can fit it through my budget, which is fine. I think sometimes, it might perhaps just result in less favorable terms with your vendor if you're putting in those cancelable clauses. I think vendors like to shy away from those. But we're going to move into our next polling question, and then Darren's going to kick us off with some upcoming accounting changes or GASB updates.
Thanks so much, Danielle and Austin. So the polling question for those that need CPE, was the implementation of GASB 96 easier or more challenging than 87? And as we're doing that, I just want to compliment you two on that conversation. A lot of times with these webinars about accounting and financial reporting, it's on the technical merits. And oftentimes we don't take the time to pause and say, what did we learn from that? And I loved, Austin, how you talked about collaborating with the auditors to get ready for your board meetings, to be able to articulate to them how these standards were not only changing what they're going to see in the financial statements, but also how things are changing operationally. So thanks for taking us through that. Let's see how folks said in terms of the challenges for 87 and 96. And as we look at that, look at that. Some more challenging 96. Not sure was actually the winner there. So with that, we've got just under 20 minutes left. We are right on schedule. But now let's be a little bit more forward-looking. What's coming down the pipeline, and what do organizations need to know and think about?
Yep, absolutely. So looking forward, so the GASB has been very active the last several years, where the FASB has sort of taken a little bit of a breath. They've tackled their major projects. And you may think, well, the GASB put out a slew of major projects. Aren't they done yet, right? I mean, you can go back to pensions and OPEB and fair value, and you obviously look at leases and SPEDAs and say, all right, when does the fund stop? Well, it's not over yet. So they've got some major projects on the horizon that we'll touch on briefly at the end, but they have also been active in pushing out new standards. Not major, I wouldn't call them major standards. We're going to walk through the most recent 4 standards they've issued, but they are relevant and things that should be on your radar. So starting here with GASB Statement 100, this standard was issued in June of 2022, and it's effective upcoming now for June 30, 24 year ends and thereafter. So you need to pay attention to this one. It's for accounting changes and error corrections. So the GASB back years ago implemented GASB 63, where they took a whole body of gap that existed, or guidance, I should say, that existed in legacy FASB statements and AICPA guidance back from 1989 and prior. And the GASB said, there's a whole bunch of topics that we don't have gap for. And so we're just going to take this legacy guidance and we're going to codify it into the GASB standards. But after doing that, they've then been going through that guidance and saying, okay, where do we need to take stuff that's in this? There was a whole bunch of different topics covered. Where do we need to provide additional gap, clarify, supersede, and come up with additional guidance? So one area was accounting changes and error corrections. So one thing this does is it removes from the guidance the terminology of prior period adjustments, which was the topic or the subject that was superseded from GASB 63. And so they're looking at two broad buckets: accounting changes and corrections of an error. Intuitively, we all know what these are. We've dealt with all of these, but they really wanted to avoid any diversity in practice and clarify, well, when do you really have a change in principle versus a change in an estimate versus an error? So as we look first at accounting changes, so a change in accounting principle, this one's pretty straightforward. New GASB standards, new guidance, authoritative guidance that the GASB issues, that's going to trigger, to the extent that it's relevant and applicable to items in your financial statements, that is a change in accounting principle. A change in accounting principle also can arise when you make a decision to move from one acceptable form of GAAP to another acceptable form of GAAP. So where there may be elections or options within the body of GAAP that you make an election, well, maybe you change your mind and decide that taking the other version of GAAP is more appropriate and better represents the economics or presents more useful information. Now, to do that GAAP to GAAP change, you do have to justify it based on preferability. And that's where you think about the qualitative characteristics of financial accounting, understandability, relevance, reliability, those types of things. So if you are doing a GAAP to GAAP change, you will have to disclose the justification based on preferability. So change in accounting principle, those get full retrospective implementation back to the prior periods, the earliest period presented if you have comparative financial statements, with a cumulative effect adjustment to beginning net position in that earliest period presented. Now, a caveat here is that this guidance is effective to the extent that there's not incremental or specific transition or implementation guidance in like a new standard that's issued. So the first thing you do when there's a new standard, you look at the standard itself, look at the implementation and transition guidance, and follow that. And to the extent it says, look at 100, that's when you're going to have a full retro, restate prior periods, and have disclosures around that. Now, changing accounting estimate, this is one where they really wanted to make sure and define. So an estimate is considered an output. So previously, estimates were considered both inputs and outputs. Now, an estimate is an output, an accounting area that's subject to measurement uncertainty, where you have inputs that result in an output, inputs such as data, assumptions, and measurement methodologies. So a change in an estimate is a change to one of those inputs. If you have new information that's new data, more experience that makes you change your assumptions, or you change your measurement methodology to improve the precision of the estimate, any of those would result in a change in estimate. And a change in estimate is treated prospectively. So you don't have any prior period restatements, you don't have any cumulative effect adjustments. If you change your estimate, you account for that on a go-forward basis, run the effect of that change through in the current year, and disclose the change. Now, if the input that you're changing is your measurement methodology, then you again have to justify that change based on preferability, and you have to disclose that. So again, if you're changing the actual measurement methodology, think of if you got a valuation specialist involved for a derivative or for some alternative investment, or if you're changing actuarial methods, something to that effect, you do have to understand and justify based on those qualitative characteristics why it's preferable. Then the third accounting change is a change, to or within a reporting entity. For the healthcare environment, we're predominantly going to be thinking about new component units or removal of component units from the reporting entity. This can also be a change from a discretely presented component unit to a fully blended component unit. Or if you do have fund accounting and governmental funds, changes, new funds, removals of funds, changes in major versus non-major funds. And those are going to be accounted for retrospectively, but only within the period that the change occurs. So in this case, you're not restating the prior period. It's not a full retro, but you are going to restate your beginning net position in the current period, the period in which that change in reporting entity to or within the reporting entity occurs. And one, again, important caveat here is that you don't follow this guidance. This is only applicable to changes in the reporting entity that do not fall under GASB Statement 69, government combinations. So if you're engaging in an acquisition or a merger or transfer of operations that falls under GASB 69, then you're going to follow that guidance. So effectively, if you acquire an entity, the legal entity, and you're going to do acquisition accounting as of the transaction date, you follow that guidance. You don't follow guidance here. That's not a change in reporting entity under 100. But other changes to component units and change in reporting entity do follow 100. Now we have a correction of an error. This one's pretty intuitive. That's an oops, right? If we had a mathematical mistake, if we misused or had an oversight with respect to relevant information that was or should have been available at the date that, at your reporting date, those types of things, or if you just have a gap departure, if you fix those types of things, those are going to be errors of correction. Those get full retrospective restatement to the earliest period presented with a cumulative effect adjustment to beginning net position as of that earliest period. So all of these items, you're going to have disclosure requirements around, both qualitative, why the change was made. You're going to have tabular disclosures that indicate which line items were affected, the cumulative impact on beginning net position, et cetera. And on the face of financials, to the extent you do have a cumulative effect adjustment to net position, you're going to actually present that on the face of the financials. So that's GASB Statement 100. 101, this one was also issued in June of 2022. This one relates to compensated absences. So this standard, this was probably going to have a little bit more impact potentially on your accounting. The GASB recognized that the legacy standard they had out there in 16, it wasn't a principle-based approach, and similar scenarios could result in different answers, particularly as things have changed since, you know, the 80s and 90s sort of employment environment to today. So the types of benefits, the types of leaves that are offered that employers are offering to their employees, the GASB recognized they need a unified, principled approach to recognizing and measuring compensated absences. So these, of course, we know what compensated absences are, right? PTO, vacation, sick leave, holiday leave, all those types of things. This standard is effective for 12/31/24 and thereafter. So again, this one, if it's not on your radar, you're going to want to be looking at it because you're either already in the period that it's effective, or it's going to be coming up on you in your next reporting period. The gist here is that you're going to recognize a liability for leave if it's already been used and you haven't paid it, or if it hasn't been used and it meets 3 criteria of it accumulates, meaning that it rolls over from the current period to another period, that the services have already been rendered, meaning the employee has actually performed the services to earn that leave. And the 3rd criteria is that it's likely to be used or to be paid in cash or settled in non-cash. Now, this 3rd criterion is the important one and the one to key in on. The other ones are pretty obvious. Does it roll over from period to period? Has the employee earned it? Those are pretty objective. But this notion of, is it more likely than not that that leave is actually going to be used or paid or settled in some way? And so this is where judgment kicks in, and you need to look at your employment policies, at the actual practices, look at historical behavior of your employee population, given the type of leave that you're talking about. And you need to make a judgment call about, is it more likely than not? So here you could end up with a range of potential outcomes, and you need to make an estimate about what to accrue. And remember, more likely than not in GASB world and in GAAP, it's generally thought of as a 50 plus 1%, right? So this is not a high threshold that it has to be probable or nearly certain. This is is it more likely than not, like 51% likely. And again, there can be a lot of complexities given, do you have a payout policy? And that may set the floor for what your range is, but someone could use more of that PTO than would be a minimal payout. And so again, some analysis is going to need to be done here and judgments exercised. Other types of leave, sporadic leave for military, parental, jury duty, those you're going to recognize the liability and the expense once it commences. So you don't need to try and look forward and make estimates about that. Similar for if you have holiday leave or if you have an unlimited PTO policy for employees. Again, that you're not going to be recognizing in advance. You're going to recognize that once it's actually taken. And the last point here that we'll hone in on is if you have a policy or a practice of converting accrued leave, compensated absences, to a pension or OPEB, then you are not going to recognize liability for that. I should qualify here, that's for a defined benefit pension or OPEB plan. I'll kind of pause there just to see if Danielle or Austin, this one I think may have more practical implications from an implementation perspective. Any just thoughts come top of mind as you look at this standard?
It does for our health system. You know, the biggest one is of course that medical benefit. So we don't pay that out upon departure, and so it's not currently recorded as a liability. It'll be a little bit of a review to see when it was used, how much we need to book in short term, how much we need to book in a long term liability. I hope it's not a huge impact, but I know that the overall balance, the balance for everybody that has accrued medical leave is pretty big.
Great. All right. So moving on to GASB Statement 102. Now, this one was issued in December 23. It's effective for periods beginning now, beginning after June 15, 24, so your June 25 and thereafter year ends. This is purely a disclosure standard, and it's on a prospective basis, but it is an interesting one, and it's one that, again, I would recommend that you take a look at because it does introduce new requirements for certain types of risks that historically may not have been disclosed. The notion is a concentration or constraint. So a concentration meaning a lack of diversity in resources, or constraint imposed by a third party or your highest level of authority that may make the organization vulnerable to the risk of substantial impact. GASB is now requiring you to catalog and evaluate everything that could be a concentration or constraint that could leave you vulnerable, and then evaluate whether an event has occurred or is likely to occur in 12 months following the issuance of your financial statements that could trigger that vulnerability. So, you know, some things come to mind that this could have been relevant to, say, like a global pandemic, right? And the types of constraints or concentrations that could have been triggered then by a pandemic. So the types of, it would be interesting to go back and think about what types of disclosures may have been required under those scenarios and play it forward here as you implement this. So this is an interesting one that I recommend you pay attention to, and maybe it's all going to be judgment, so you're going to want to coordinate with your auditors, but we will see what this looks like in practice. The last standard we're going to touch on here is financial reporting model updates for 103. This one's down the road a little bit. It was just issued in April of 24. It's effective for June 30 of 26 year ends and thereafter. Now, this doesn't change anything with respect to recognition or measurement of financial statement elements. This is purely presentation guidance. And the GASB actually significantly narrowed the scope of this standard. A lot of general governmental entities had a big sigh of relief because there was likely a substantial impact based on the original scope to them. But now it's mostly impacting organizations like healthcare providers, higher ed that engage in business type activities and proprietary fund reporting. So there's some pretty significant changes to the MD&A that we won't go through, but really get to avoiding boilerplate dialogue and avoiding repetition and being more specific about the types of what the drivers of changes and significant call outs in your MD&A. They've restructured a little bit the buckets of requirements. So this is another one that I would say take a look at well in advance so you start thinking about how your MD&A, if you present that RSI, would change. And then the big change from a presentation perspective is on your statement of changes in revenues, expenses, and changes in net position. What they've done here is defined operating and non-operating revenues. They've changed GASB 34, and they defined operating revenues based on the definition of non-operating revenues. Operating revenues simply mean anything that's not defined as one of 5 types of non-operating revenues. Non-operating revenues being investment income, financing activities, interest expense, issuance, gains and losses on disposals of assets, and subsidies. So capital and non-capital subsidies. Think about contributions and what historically you might think of as non-exchange transactions. There is one item here that this whole notion of subsidies that the healthcare industry, the P&P board, the AICPA expert panel have been in discussion with GASB, and we expect some implementation guidance probably to come out around certain types of arrangements. You may think about Medicaid supplemental payment programs, or other types of programs that may be considered a subsidy depending on how you read the definition. So I would just say stay tuned to this standard and look for implementation guidance around what is considered a subsidy that would be required to be reported as non-operating. A couple other changes, they got rid of the extraordinary items and special items and created just a single unusual or infrequent items. As we expect, historically, those have been pretty unusual or infrequent to see in your financial statements. We still expect those that will be pretty rare, but they did collapse those into a single standard. And there's a new clarification for required supplementary schedule of major revenues by source. In terms of GASB projects, the big one here to look at is revenue and expense recognition. The GASB is looking at moving away from the exchange, non-exchange model to a performance obligation model that kind of mirrors Topic 606 in the FASB world. So that one's several years down the road, but definitely keep an eye out on that one. It could have a substantial impact in terms of how we evaluate contracts, but I don't think it'll have a significant impact on the actual timing and pattern of recognition. So with that, we're coming up at the end of the hour. I think we have our last polling question.
Thanks so much, Darren. And as the Emmy music plays for all of us to start exiting the stage, we'll take our last polling question for all those folks. If you have any final comments on that last slide, we'll take that too on the GASB projects here. Otherwise, we got a couple questions from folks that we didn't get to in the Q&A, and we'll follow up with you on that. Thank you so much to our esteemed panel members, Darren, Austin, Danielle, and appreciate everybody's participation today. And as they answer the last question, which new standard will have the biggest impact on your financial statements? We'll take a quick look at the results and then cue the administrative items to close out the webinar. Let's see our results. Ooh, it's mixed. We got a lot of work ahead of us. Luckily, you can call Darren and Danielle to help you. Austin, special guest, thank you so much for joining us, and we'll turn it back over to our administrative folks to help us close this out.